Nike still dominates. This is a major company. You should pay a premium for that because they get double the return. Wow. We want over 5%. Nike still dominates. Nike is one of the greatest companies of all time. Its entire story from beginning to end is incredible. They've got quite the brand. You know, a few years ago, when Under Armour was nipping at its heels, everybody's like, oh, Nike's good. No, Nike still dominates. Now, do they have their issues? Of course. Every company has its issues. But our goal on this channel is to pick great companies and find out a great price to buy them at. What does that mean? Well, that's the art of investing. So if you're new, please watch this video. If things sound confusing to you, it's okay. They were confusing to me the first time I heard them from other people. That is the point of learning. We're here to teach you how to fish. I'm not here to just hand you fish and say, go buy this company. I'm here to teach you a process. Your process will end up being different than mine. But the point of all of this is that when you find your process, you're going to be a much better investor. So let's check out Nike. So if I'm going to pull up our software, and of course, if you have our software, then pull it up along the way. Nike is up today. Now, last year, and you look at our software here, it tells you how it's done in the last week, it's up 5%. Last month, 13.5%. So, all right. Now, the stock is currently at 127. That doesn't really mean much to me because what matters to me is what's behind that. So, a couple key attributes here. Their free cash flow is down a lot. In the last year, they have $1 billion in free cash flow. In the last 5 years, they've averaged 3.84. So, the first question you have to ask yourself, is this a permanent change in its free cash flow? My guess is it's not. That's just my guess, but we're going to dive more into it. They pay a dividend of 0.7%, which ate up about $1.44 billion in free cash flow. And based on the last year, they can't afford that. So they really need to get this 5-year average going. Gross margin, 45%. Okay, pretty good for retail. I mean, they manufacture everything themselves, right? So that's important. And the bottom line profit, pretty consistent. I mean, 11.5 seems like a pretty big number. But as you see, they didn't have a drop in profit, but they had a drop in free cash flow. All right. So it was probably a change in working capital is my guess. I just actually want to go look at it now and see if I'm right. There you go. Changes in working capital went from 400 million to 137 to a minus 3.24. That's your change in free cash flow there. Because before they were doing 3 billion, 4.7, 3.4, 3.6, 6.5, a billion. So I think this is a very temporary problem as they work through their inventory issues. All right. So let's go back here. Look at this. 5-year return on invested capital. 20.6%. Wow. We want over 5%. That's a really high return on invested capital. That means they get a great return on the money invested in the business. And you should be willing to pay a higher premium for companies with a high, consistent return on invested capital. The last year was 18.7. The last 5 years is 20.6. So it seems very consistent. Okay. Now let's go look at this also. Market cap of 195, enterprise value of 213. The difference here should be the debt. So there's not much difference. I mean, essentially debt. There's not much difference, which means this is not a very highly leveraged company, which I love. All right, let's go check out their 8 pillars. Okay. Obviously cash flow dropped, so I'm not worried about that. I'm not even going to look at that. And the only other X's are PE and price of free cash flow. It's expensive. Now, again, should you pay a premium for great businesses with high return on invested capital? Absolutely. But what's the premium? Is it really worth 45 times? This is double where we want it to be. Double. Okay, let's go see analysts and see what they're saying about the growth rates. All right, so the EPS growth. They have $3 expected for the calendar year of 2023, ending June, and they're expecting $7. So over double in the next 4 years. That's a growth rate of 20+%. But look at the revenue growth. That's what you have when you have high return on invested capital businesses. They can really jump up their earnings per share with a lot less capital than other companies. So if two companies are exactly the same, one has a 20% return on invested capital, one has 10%. The 20% return on invested capital business needs to invest half the money back into the business to get that same growth rate in terms of earnings that the 10% one does, because they get double the return. That's the way to look at it. It takes less capital to increase the earnings. That's the way I want you to look at it. And you should pay a premium for that. So then I guess the question becomes, what do you pay for Nike? So Nike is one of those companies I want to own for 1 billion years. So I'm actually going to do a 20-year analysis here. You'll get a higher number doing a 10-year analysis. But if I'm looking for companies for a long period of time that are going to be around, I want to sit there and look at 20-year numbers. Now, with 20-year numbers, though, as the company goes larger and larger, you have to make a lot more long-term guesstimates on revenue growth. All right. So what's a company as big as Nike going to grow over the next 20 years? I don't know. That's the reason we have 3 levels here. I'm going to put a really low number in, let's say they do the last 10 years for the next 20, which is probably not very likely, but let's go see. So on revenue growth, I'm going to go with 3, 5, and 7. Man, I still think that's low though. Man, 3 is very, very low. See, I don't even like that. See, that's what I'm doing right here. I'm looking at going, no, I'm going to go 4, 6, and 8% revenue growth. Profit margin, it's very consistent. So I'm going to stick with 10, 10.5, and 11. Free cash flow margin, I'm just going to go 9 all across the board. Make it easy. Now, PE and price of free cash flow. It's asking, what's the PE and price of free cash flow going to be in 20 years? Now, remember, Nike's going to have an even bigger moat, which is likely in the next 20 years. However, the bigger the company is, the average PE is about 15, but it has a high return on invested capital. So what do you balance it with there? So I'm actually going to go 14. Nope. I'm going to go 15, 16, and 17. I'm going to do the same thing with the price of free cash flow. Actually, you know what? I'm going to go a little bit higher on price of free cash flow because it looks like their free cash flow and their earnings are just a little bit different, about 1% off. I'm fine with that. Now for my desired return, guys, this is a major company. There's not a lot of risk with Nike. I would be absolutely floored if Nike was not around in the next 20 years. I would actually look at it and go, what the hell happened in this world that caused Nike to fall off the face of the earth? So I think a desired return that's less than normal would be appropriate. Now, again, you can get 9 or 10% from an ETF. So I still think you should have a higher desired return than 9 or 10%. But this is your margin of safety. How much margin of safety do you need when it's this low of estimates, right? Now, actually, if somebody said to me right now, Paul, I'm going to put 10% in here for my low estimate, I'd actually say, okay, I think that's reasonable because even though it's matching your market return, these assumptions are very, very low potentially. Is that for sure? No, it's not for sure, but I wouldn't be surprised. So I'm actually going to go do something I rarely do. I'm going to go 10, 11.5, and 10, 12, and 14 because this is going to be difficult. And I think, actually, I might go a little bit higher than that, actually. I think I'm going to go 10, 12, and 15%. Because I just think 8% a year growth for the next 20 years is a big, big, big number. I just don't think this is possible, so not probable. So I really need to put a high margin of safety in there. So guys, I'm going to hit the analyze button. Now remember, guys, if this was confusing, I understand completely. I've been there. You might sit there and think I'm making that up. Guys, there were times I couldn't even look at an income statement without just like crying, essentially. I didn't know what I was looking at, but that's the reason why we do so many videos. We do 14, 20 videos a week, and a lot of them are looking at individual businesses to explain the thought process. Because when you buy a stock, you're buying a piece of a business. So subscribe to the channel. If you like the software, like all the stuff you see on it, plus this community of people, like we have thousands of people in here talking about Nike, talking about all these companies. You can go in there and search and go engage in the conversation. We have a risk-free offer, money-back guarantee. Check out everythingmoney.com for it. So I hit the analyze button. This is going to be so low, it's going to be funny. Boom. Isn't this funny? Look at this. Look at this. This is weird. It actually goes lower. So basically, guys, $50 is the number. That's what I'm looking at here, right? Everything's falling in the numbers of $50. And if you look, my watch list is currently at $60. Now, why do I have it at $60? Not because I'm buying it at 60, because I want to sell puts at lower prices to buy it around that 50 number. So that's where I stand on Nike. Remember, do your own research. If it ever hits $50, don't go out and buy it just because I said so. Do your own research, join the community. It'll be well worth it. Thank you for your time.